Awesome. All right. Welcome everyone to another Get Legit webinar. This is cash flow statements and accounting best practices. Today is Thursday, February 15th, 2024. My name is Erin. I am the Education and Communications Manager here at the Cannabis Alliance. Thank you so much for joining us. It is our hope that anyone interested in commercial cannabis here in Nevada County will take the time to tune into these webinars, educate themselves, and continue to be or become stewards of the environment and of our community. These Get Legit educational webinars provide the preparation necessary to assist in securing a local cultivation permit and a state cultivation license. The series include webinars, support groups, business skill training, and a mentor program. All Get Legit webinars are online, they're free of charge, and they are open to the public. We have another upcoming Get Legit webinar. It's Tuesday, March 19th, 2024 from 3 p.m. to 5 p.m. on how to use social media to market your cannabis, basically leveraging social media tools to elevate your brand. We'll be joined by social media and cannabis marketing specialist, Elizabeth Udell. So mark your calendars. You do not want to miss that one. Some upcoming events with the Alliance. We have a really fun event coming up. It's a movie screening of Reefer Madness at the Nevada Theater with a pre-celebration at Elixart. The tentative date for that is Wednesday, May 8th, 2024. So stay tuned. Mark your calendars for that as well. We'll be sending out more information soon. We also have a member meeting coming up in April. So stay tuned for more details about that as well. A little shout out to our allied industry business sponsors, Ag Natural, Four Seasons Garden Supply, Foresters Co-op, Humboldt Seed Company, and Happy Sap. Thank you so much for supporting the Alliance and for all that you do. So a little bit about us. We are a nonprofit trade association representing the local cannabis community here in Nevada County. Our mission is to support public policy initiatives through representative advocacy, provide educational opportunities, and create space for connection within the industry and the greater community. Some services that we provide to our members are things like consistent voice and representation locally at the Capitol and through our statewide partners, Origins Council. Be sure to check them out as well. We have monthly educational webinars to assist with the permitting and licensing process, much like the one you are on today. We have a buddy program to pair permitted farmers with new farmers. We have a Slack online hub for resource sharing and local policy updates, a great way to communicate with members and sponsors in the local cannabis community. We also have seasonal supply chain industry mixers. There are ways you can stay in touch with us. You can become a member, much like all the services that we provide to our members that I just listed above. Lots of benefits to being a part of the Nevada County Cannabis Alliance. If you're watching this and you are interested in sponsoring the Alliance, you can become a sponsor as well. I'll be linking to the in the chat for how you can participate in these programs. You can follow us on Facebook and Instagram. Our Instagram handle is @Nevada County Alliance, and Facebook is just the Nevada County Cannabis Alliance. We have a bi-monthly newsletter. I will list that in the chat as well, but you can just go to our website, click join us, hit our subscribe button. It's as easy as 1, 2, 3. Any additional questions, of course, reach out to info@nccannabisalliance.org. For today's webinar, we have Julia Glass. She will be giving us a presentation on cash flow statements and accounting best practices with a Q&A to follow if you do have any questions. Your participation is very encouraged. That chat section and Q&A is there for you. So ask questions that you may have to make this webinar more useful for everyone. Again, this webinar is being recorded and will be available on our website at nccannabisalliance.org under the Get Legit tab sometime next week. And then that is it on my end. I'm going to go ahead and pass it to Julia Glass to introduce herself and move forward with the presentation. Thanks, Julia.
Yes. Hello, everyone. I'm Julia Glass, and I am a bookkeeper. I specialize in QuickBooks, and I'm a pro advisor for QuickBooks Online. I'm a certified QuickBooks Online pro advisor, but I've been using QuickBooks for 30 years, long time, probably since the 1990s. And I've been a good bookkeeper for, about 40 years. I'm not an accountant. I'm not a tax advisor. So everything I do, you have to take with a grain of salt. It's not meant as tax advice or even about accounting principles. but I can walk people through financial statements and work with that. So I wanted to say that when I use the word compliance, very specifically, I'm talking about compliance to what are called general acknowledged accounting principles. So in our kind of field here, dealing with, I'm going to assume primarily cultivators, the word compliance triggers a lot of thinking, probably mostly with compliance of, compliance to regulations for the state and the different agencies. So when I use the word compliance, I'm not talking about that at all. I'm only talking about compliance with generally accepted accounting principles. And so that kind of moves into a little discussion about that, which is if you have a business entity, like a corporation or an S Corp or a limited liability company, then you're required to keep financial records that are generally accepted as being reasonable. And so that means they must comply with generally accepted accounting principles. You might see it abbreviated as GAAP. And so there's that onus that you need to keep your records in that way to meet the regulatory requirements for having a business entity. And also if you are filing financial statements or information returns with agencies like the California Department of Tax and Fee Administration, all of those records need to be kept as according to GAAP standards. And one of the things that about that is that a lot of people will keep cash records. So there's two forms of accounting. There's accrual and there's cash accounting. And with accrual accounting, let's see, I have a little blurb here because that says it much better than I can remember. But with accrual accounting, you post revenue when it's earned and expenses when they're incurred. And this is one of the things why we have a cash flow statement, is because what that means is that when you create an invoice for a customer, that's when you earn that revenue. But you may not collect that money when you create the invoice. So you create a thing called accounts receivable. So that's money that someone owes you. And then when someone sends you a bill, that's when the expense is incurred. And so that's when it gets posted to your books in the accrual method. But you may not pay that bill. You may not spend that cash until a future time. So that's how that's how revenue and expenses don't necessarily completely line up with your cash flow. And hence we have a cash flow statement. In cash accounting, you post income and expenses when they actually occur, when the money comes in your bank or you write the check for the bill. And that's one way to do business, but it does not meet GAAP requirements, the generally accepted accounting principle requirements. So you have to use accrual accounting to meet the requirements of reporting agencies and things like that. So it may be a little abstract, but it's information. So one thing I wanted to do is, if anybody has any questions, put them in the chat and then they'll let me know. As I said earlier, I'm going to assume that people are mostly cultivators. And if anybody has any specific questions or something I'm saying isn't clear, ask me right away, because otherwise we'll just go further along and it'll just get muddier and muddier. And the thing about, if you feel intimidated or brain dead about financial statements, you're in a multitude of companies. I would say most people when you pull out a P&L or a balance sheet or a cash flow statement, their eyes glaze over, and some people actually, might pass out because it's like, oh my gosh, what am I going to do with this? So if you are in that category, one thing I encourage you to do is just look at these statements, even if they don't make sense to you, and then over time they will make sense, especially if you have someone to go over them with you. So I'm going to just quick review. We had covered a pretty in-depth exploration of the chart of accounts and the balance sheets. So I'm going to share my screen. I think I can share my screen. Yes, there we go. Oh, the screen sharing is disabled. So if you could turn that on so that I can share that.
I just fixed that for you, Julia. Apologies.
Okay, great. There we go. Great, there we go. So I wanted to go over these at the very beginning just to kind of familiarize ourselves with what they are. So the chart of accounts is, okay, I'm just going to make a little stop here. So I'm going to primarily come at you from the perspective of someone who's using a financial software. I use QuickBooks. There's other financial software out there that people use like Xero or Wave or Sage. So all of these software applications, follow this format. So when you use them, they will automatically generate these reports for you. You can actually, keep manual records like an Excel spreadsheet or in a ledger and create these reports yourself, but I'm not going to address that. If that's something that you're doing, you probably could find a lot of stuff on YouTube or something to help you with that. But I'm going to assume that you're able to have like a standard report generated by a reasonable software, accounting software application. So you have a thing called a chart of accounts, which is a list of all of the things that you need to keep track of for your financial records. And it's broken into basically two sections: your balance sheet at the top, profit and loss accounts at the bottom. So this is the chart of accounts, and this is all of the different envelopes that you're going to stuff money into or transactions. And then there's a standard numbering system that is or isn't significant. So at the top here, we have the balance sheet accounts. So these are the different kinds of postings that will be used to create your balance sheet. Your list of assets, which includes cash and cash accounts, anything that you own, like a building or equipment, deposits that you've given to somebody for renting a facility, that goes in there. Then liabilities are things that you owe to other people, loans, mortgages, etc. And then the equity accounts are where the money that comes and goes into like the money that you use to start your business, and then the money you take out of it, like for personal draws or distributions. So this is broken up into these three sections, and it's the top part of the chart of accounts here in this blue section. And this is used to create a balance sheet report. Then the bottom section is the profit and loss accounts, and these are used to create your profit and loss statement. Some people might call it an income statement. There's a trend in accounting now, at least in QuickBooks for sure, to start referring to things in more friendly terms as opposed to like accounting terms. So you might hear people talking about things like in different ways because they're trying to make them less foreign or frightening. So you have revenue and then cost of goods sold, which is, what you use to produce the actual goods and services that you're selling. And then you have expenses down here, which would be the expenses that you generally have for a business, like telephone, repairs and maintenance kind of going down. Then other income would be money that you would get from not from the regular course of doing your business, and other expenses would be expenses again that are not part of your business practice, like taxes. Like if you're taking taxes out of that, those aren't deductible expenses or whatever. They're other expenses. So this kind of makes up the chart of accounts broken into balance sheet accounts and profit and loss accounts. This is like where the cash flow statement begins. So like I said before, if you're using accrual accounting, when you post revenue, you may not actually have cash to spend because you're going to create an invoice and then someone might pay you at the same time, or you might have it out there. So you would post that revenue, but you may or may not have the cash. And the same is true with bills. So, and then there's also expenses that there's things that you spend cash on that don't even come into the profit and loss statement. For example, if you have a mortgage, you have over in your balance sheet, you're going to have mortgage, you're going to have long-term liabilities here in like a mortgage down here. Now, when you make the mortgage payment, that doesn't show up. You're going to spend cash doing that, but it's not going to show up on your profit and loss account because you're not actually purchasing anything for it. You're paying back a debt. Then the portion of your mortgage payment that will show up in your profit and loss is the interest portion of it. So like say you're making a payment of $2,000 on your on a loan or mortgage that you have, and then 1,000 of it is for interest expense, that will show up over here on your profits and loss statement. And then $1,000 will reduce the amount of the liability on your balance sheet. But the cash that's going out is $2,000. So your P&L isn't going to show that, and neither is your balance sheet. So that's part of what a cash flow statement it works to capture, is those the difference or the disconnect between revenue and expenses and the amount of cash that you have in the bank. So I'm going to pull up this thing. This is a kind of really down and dirty basic cash flow statement. I liked it because it was really big, so I thought people could see it really well. So the cash flow statement is kind of pretty simple in concept, but it's a little bit, for me, it actually is kind of challenging to understand in a way. So what you do is it's really simple. You take the cash at the beginning of your period, and then you take the cash at the end of the period, and then you subtract one from the other, and then it shows whether you had an increase or decrease in cash. And what you do is there's these 3 different areas here, which is operating activities. And that's where operating activities would be the income that you get from doing the normal course of business. This is the cash generated from the sale of products and services. And then investing activities are the things that you do that are outside of your core business activities, such as purchasing a piece of equipment, selling a piece of equipment, buying another business. So those things increase or decrease the amount of cash that you have available. So if you sell a piece of equipment, then you're going to get cash back, but it doesn't come in on your profit and loss statement because it's an asset, so that you're going to get cash that won't show up in your profit and loss statement. And then cash flow from financing activities. And this would be like getting a mortgage or a loan and then making payments on that. So then you start with the amount of cash that you have, then you make these adjustments, and then you come up with the net, you subtract or add them from your starting cash, and then that gives you a positive or negative number. And then that tells you whether you had more or less cash from the beginning of the period. Does that make, I'm hoping that that makes sense. So I'm going to pull up, this is an example of a statement of cash flow to kind of look at this a little bit in a more practical sense. So the numbers on your cash flow statement are gotten from your P&L and your balance sheet. So they're derived from those two other reports. So here we have this number, which is net income here. And if we go over to the profit and loss statement, we see down here, here is that net income number. This is another thing that I maybe wasn't really clear about is, so cash flow statements are intrinsically comparing a previous period to another period. So whether that would be a monthly, you can do them monthly, you can do them weekly, you can do them yearly. What we're going to be looking at here is an annual cash flow. So this is, as we can see here, this is the net income for 2022, 1642.46. So we come over here to the cash flow statement, and here's the net income. So this is where that number comes from. You start there with the net income from the prior period. Then you make adjustments to it where you either add or subtract the amount in your account of the difference, the change in your accounts receivable. So what happens is that if you have, so you take the accounts receivable, so you have balance sheet, okay? You would take two balance sheets. This doesn't show the prior periods. It's not expanded, so it's not the greatest thing, but it's what I have. But your accounts receivable would be here under your current liabilities. So you would take the accounts receivable from the prior period and your current period, and then you would subtract one from the other, and then you would end up with a positive or negative number. So if the prior period you had less, let me find my note here, because I always get it mixed up in my head. I pull these reports and I look at them because QuickBooks does all of this for you. So I'm trying to explain where the numbers come from and explain why that happens. So in the cash flow statement, we're going to make these adjustments. So we're going to see here, we've got that net income, and then we've got the accounts receivable. So it's going minus, you're subtracting that. So that means that you have less accounts receivable than the prior period. So that reduces your available cash by that amount of money, because that's money that you're waiting to get. You're waiting to receive that. So you're taking it out of your cash because you haven't gotten that money yet. And then an inventory asset, you're adding that. So that means that you spent $600, $596.25 more on inventory than the prior period, or the value of inventory is that much more than the prior period. So you have that $600 that you spent in cash sitting in inventory. So it comes out of your cash total and goes into this adjustment. Now, accounts payable is an increase in cash. So when it's increased, that means, oh, I paid a whole bunch of bills. So I have $1,600 less due out to pay people. So I have $1,600 more of cash to spend. And then again, the adjustment for your credit card, that would be, you know, you take out what you owe on the credit card from a prior period. And so this is showing that you have less than that you have less outgoing debt, so you get to add that to cash. That means I have $157 more to spend because I paid off a payable. And then again, we would go down through these other accounts here. So you would put these adjustments in, and your software program will do this automatically. But the idea is that I've got my net income, and then I'm going to, that income is impacted by the cash component, because my P&L is in a accrual basis. Again, I write an invoice, people will owe me money, I get a bill, I have to pay money out. You make these adjustments here to give you the idea of how much actual cash you have. Because your P&L could say you have minus $5,000, or you have a profit, or you've got a loss, or you've got $10,000 of income, but in your bank account, you may not see that money, or you may not see that negative, because depending on what kind of financing and stuff you're doing, the actual cash that you have is impacted by that. And so then we go down here to see investing activities. So here there would be, this would be that the piece of equipment was sold because it's negative. So this is where you would, this is where, because it's saying the original cost of the truck. So this means that this, that you had a truck and you must have sold it. So the original cost is coming out of your investing activities because it's reducing your available cash. Or you actually bought a truck. That's what's happening here. You bought a truck for $13,495, and you're not going to see that in the profit and loss. You spent this money and it increased your assets on your balance sheet. You're going to see that on your balance sheet when you look at equipment or fixed assets. So see, here it is, $13,495. So you bought a truck and it's on your balance sheet, but you're not going to see that over here under automobile because it's not a profit and loss statement. You're transferring cash, the money, $13,495, into a truck. So you're converting that. So you're moving that from a cash account into a fixed asset. So that's showing, but you have that much less cash to use. So it's coming out of your cash flow statement. And then down here was where, and it would be different for each business. You've got your financing activities, your notes payable, which would be like a mortgage, and then opening balance equity. So these would be changes. You would pull a balance sheet from a prior period. You'd have a balance sheet from the period you're examining. You'd take the difference, and these adjustments get added in here. So what this cash flow statement is saying is that at the beginning, I had $1,642 of cash to spend. And at the end of my period, I had $4,000 of cash to spend. And this is the reason that this has happened here is because I took out a loan here for $25,000. So this added cash, available cash to me. So there's, are there any questions at this point? Maybe you could put them in and then they can let me know about that if there's any questions at this point. So primarily there's these three different sections to the cash flow statement. There's this top one, which is operating activities, which I'm going to repeat. Those are the income that you get, the revenue that you receive from the regular course of business of selling your goods and services. Then it's broken down to investing activities, which would be the purchase or sale of assets. It could be any kind of asset. And then financing activities, this is where the reduction or addition of cash would be posted based on getting loans, making calls to partners for investments. This is where you would also put owner draws or share distributions, because those reduce your available cash. If someone gives your company business, it increases your available cash. That's why the notes payable increases that. But if you turned around and made a distribution to partners, then that would decrease your available cash, but it wouldn't show up on your profit and loss. So there's these three different sections: the operating activities, investing activities, and financing activities. And then they're reconciled down here with this little line item here. So the net cash increase has to equal the cash at the end of the period. So that's a reconciliation that happens automatically in QuickBooks. But all of these numbers, when they add up and are broken down, they will equal each other. So there's we'll see here that at the top under operating activities, there's a positive number at the bottom. And then down here under investing activities, there's a negative number. And then down here under financing activities, there's a positive number. So most people will tell you, so this configuration of plus, minus, plus, each section, whether it's increasing or decreasing, can give you ideas about what's going on with your business and also indicate different types of periods. So let's say that, so most people are going to tell you that this number here, the net cash, has to always be positive. Well, there's lots of conditions that could happen where that wouldn't be the case. But if it is a negative number, then most people are going to like go, oh, okay, something is out of balance here. What's happening? So like one thing that you would look at is your accounts receivables, because that's one of the fluid things. So if you have a lot of receivables, it's going to reduce your cash amount. So if you see that my receivables are, minus $10,000 and my net operating is minus $2,000, you're going to see that there's an imbalance there with your accounts receivable, and you need to get on the phone and get some money in. Another thing would be these are the two areas where you would tend to look dynamically to is in your inventory asset. Another thing that will drive your available cash down is the purchase of inventory. And so if this is a big negative number, then it's letting you know, oh, you have a lot of inventory. But there might be reasons that you would do that. Like I have a friend that has a business and she has to buy these bottles from Europe to package her product. And in order to do that, she needs to buy like skids of them because they're manufactured. Because she can't buy them retail or through a distributor, she has to buy them from the manufacturer. So she has to invest all this money in these bottles. And so when she does that, that throws up her inventory asset and it skews her available cash. But that's good for that. That's something that she knows about. So if you don't know what's going on with that, then these would be red flags for you to go, okay, I don't have any cash. Where can I get more cash? One, I need to call in receivables from customers. And two, I maybe need to do a fire sale off of my inventory assets, or I need to stop buying inventory that's not completely essential. So you pull back on that, and then that replenishes your cash resources. So the other thing here is like this negative investing activities here. So if this was a positive number, so it's a negative number now. So what it's telling us is that this business is investing assets in the acquisition, is investing cash, sorry, in the acquisition of assets. So if this number were positive and adding a bunch of money to the cash flow statement, that would be telling you, oh, this business is selling off businesses, is selling off equipment. It's not necessarily a positive because it could be a sign that this is the solution for their cash flow problem. So they're selling off vital assets in order to get enough money to make payroll. So if this is, so that gives you a clue about what's going on in that business. And the same would be true down here in financing activities. This one is a plus, you know, it ends up with a plus number down here. So that's telling us, we can see clearly here, this business took out a loan, a note from somebody for $25,000 to get an infusion of cash into their cash flow. But that also increases their debt. So if a business was paying off these loans, then this might be a negative number because you're reducing your cash because you're paying off long-term debt. So that is pretty much what I have to say about the cash flow statement. Are there any questions? No?
Feel free to reach out with any questions, guys. You can just pop them in the chat and I'll let Julia know what the question is and we can get your questions answered right here in real time.
Just looking at my notes to see what I missed here, if anything. So just kind of for giggles or whatever, this is a little bit of an arcane thing, but there are two different methods for creating cash flow statements. This is what's called the indirect method, which is using the comparative values on your balance sheets. So you would take a prior period balance sheet and this one and do the difference. And that's called the indirect method of a cash flow statement. And then there's another method called the direct method where you like build it yourself using your income statements. And my gosh, I had something I was going to say and it just totally popped out of my head. What was it I was going to say? Well, one of the things is that most people, this may or may not be, you know, kind of meaningful to you. Because I think that like most small business people, such as yourselves, are looking for actually, what do we do with how do I manage my week-to-week expenses and things like that. So I wanted to pull this up and show it to you. And this is actually a cash flow planner that comes from QuickBooks. And I know that there had been a tool like this that Rolling Hills Bookkeeping had given away like years ago at the very beginning. So this is a way for you to plug in things. This one is set up on a weekly basis. I have another one that might be a little more, might be a little bit easier to see, to follow. Okay. So this would be a thing where you can like plug in your your different expenses like on a monthly basis, like uh, put in the revenue that you're going to be getting, your expenses, and then come up with some numbers like, well, how much cash am I going to have? Actually, I think the other one might be easier to look at. So here's an example of this cash flow planner that has been filled out, and it may be useful to you. I'm happy to send it to somebody who wants this. So we started with the start date for this is January of 2024, and it's going on a week by week basis. So this person, they're plugging in their invoices, the money that they're getting on each week. And then down here, they're plugging in the money out. They're plugging in their money out. So this is something that you could do on your own and project forward. Like I expect to get, you know, I'm going to be doing $5,000 a month of billing. And then you could plug in your regular expenses down here. And then this is going to tell you, see, it tells you in week 3 that you're going to run out of cash. So the week of January 26th here, the way that this tool is filled out, you're going to run out of cash. So this tool might be useful for people like where you want to plug in, your property tax, what the different cash things are going to be. And then this will predict for you, oh, you're going to need to get more money by this particular date, which I think is really where most people's considerations are, is like, when am I going to run out of money? Am I going to have money to pay my excise tax bill? Am I going to have money to pay my property taxes? Am I going to make my mortgage payment? Am I going to make payroll? So this kind of spreadsheet tool is a thing that you could use to do that. And plug numbers in and play with it and see what happens. Then there's a section down here where it says explore options for reducing cash flow. Like here it says I'm going to defer my loan payment. So these would be, and then it adds it back in here. I'm going to defer it from January to February. And, so it's looking at ways to adjust how much money I'm going to have and how much money I'm going to have to spend. So I think functionally, that's what people want, is that to know how much money I have to spend.
That's awesome, Julia. Pat Rockwell made a comment in the chat that they would love a copy of this cash flow planner. Is there a way to get a copy of this to everyone?
I can send it to people who ask for it. And I could give one to you guys and you could maybe make it available.
That would be awesome. Yeah, we can link it to all in all sorts of places for people to copy. That'd be great.
Okay.
And there is actually another question.
Okay.
Sebastian has a question.
Hey, Sebastian.
Hey, Julia, nice to see you. Thanks for the webinar. Can you speak to calculating inventory assets? For example, how would a farmer with remaining inventory at the end of a year calculate their inventory asset?
Right. So this is like, it seems like that should be a simple question. But there's 2 ways to calculate inventory. One of it is on fair market value, and the other one is on the actual cost of inventory. So usually when you start your business or you start reporting or you start doing tax returns, you have to decide what that's going to be. So say you have, so depending on what your fair market value is, you can make adjustments with a journal entry. So if you're doing the cost of it, there's just no way around that. You spent this much for it, and that's how much it costs. Like I bought these pencils for $10 and I spent $10 on them. So if you sell them for $20, you make a profit of $10. And if you sell them for $5, you have a loss of $5. So if you're doing it by the cost of the asset, then there's really nothing that you can do with that, except if there's a loss to that asset, like say you had damages. So I'm not quite sure, maybe if you had an idea about what the calculation of inventory assets, what your question is, that might be able to be a little bit more clear. But if you're doing it by fair market value, you could make intermittent adjustments based on the fluctuating value of your material. And to do that, you would use journal entries, posting to a temporary account called deferred loss or gain. You would create an account to hold that difference, because you can't express the loss or gain of an increase or decrease in asset until it's sold, if that makes sense. So like you don't actually know if you have a loss until you sell it. You don't know what the profit is until you sell it. So if you're going to reevaluate that, you need to put it in a temporary holding spot. And that's one of the weaknesses of the chart of accounts. That it's one of the weak points there, is that you can't just change the value of something without putting it somewhere else and giving an explanation for it.
Yeah, hey Julia, I think I got unmuted.
Yes, hey Sebastian.
Yeah, I know that's kind of a loaded question, having had multiple bookkeepers and tax returns and whatnot. I just guess, like, more generically speaking, I mean, it seems like it's a way in which one can sort of like you can kind of take it whichever way you want, right? Like, for better or worse, you can make that cost of inventory worth more or less depending on how you want your books to read.
In theory, yes, but you do have to explain it.
Right, but it's like how you're interpreting it, right? Like, the way we do it is cost of production, but the cost of production is a pretty difficult thing to figure out at the end of the year when we don't even know how many total units of whatever it is that we're going to have, right? Like, before things are processed, before it's trimmed, before it's sold.
Right.
It's mountains of,
yeah,
material.
Well, that's where I don't know how so the trick behind this is to convert costs into inventory, is to assign your production costs. So the way that you do that is through a thing called cost accounting, which is a relatively meticulous and arcane branch of bookkeeping / accounting, where, like, for and in order to comply with the 280E requirements, the way to convert indirect expenses into inventory is through cost accounting, and that's in the 441C tax code or directives there. So what you do literally is you make projections. So it is not actually a kind of shot in the dark. It actually is very regimented, but it's a rigorous set of accounting and counting that you have to do. So you make projections and then you put it into this spreadsheet and you do inventory every month, and then you make adjustments, and then you post into your books, and then you do year-end corrections to equal the amount of inventory you have against the work in progress. Like you would call, like say you have finished flour, so you would have finished flour with a certain weight, and then you'd have stuff that's in production. So you call that works in products, and you assign a value to it based on the amount of material it is, and then you take your indirect costs, and then you figure the percentage of those that can be converted into production, and then you apply them based on the percentage of completion of your yearly, monthly production. So it's based on, did that make sense? The cost.
Yeah, I mean, I know that it's definitely a complicated process, but I think what makes sense the most is what you said about the year-end correction. Like
right.
Basically it all balances out at the end.
Right, correct. Right.
I've tried to have bookkeepers and accountants explain their formulation for those projections and like cost analysis, but it gets, over my head pretty quick. So,
right. Yeah.
That said, it's good to know that it all balances out, however, it's set up to.
Yeah.
So
and
thank you.
Typically for your books to be compliant with GAAP general accounting principles, those adjustments should be made monthly, minimally quarterly. And if you're, depending on the amount of stuff that you're moving, an annual adjustment could be defended. But if you really want to protect yourself against audit, you would want to do those cost accounting adjustments quarterly, at least quarterly. Annually is a little bit, if you're an outdoor grower and you're only doing one crop a year, an annual, you can make a good defense argument for that. But if you're growing cycles, or you're growing indoors or in greenhouses and doing 2 or 3 or 4 crops a year, you really would want to do that. Make a quarterly cost of goods, not cost of good. Well, I guess it is. It's a transference of indirect expenses into the cost of inventory.
Gotcha. Well, thank you so much for taking the time to break that down for me.
Yeah, you're welcome. I hope it made sense.
It did.
Good. So we've got 2 minutes left. Are there any more questions?
Julia, hi.
Yeah.
Hi, everybody. Thank you so much for just lending your expertise and great advice. This is so incredibly helpful to everyone. So I'm just really grateful to you. Thank you so much for coming on.
Yes, thank you for having me. Always a pleasure. And I'll be sure and send you that cash flow planner that you can send out to people to play with.
Great.
Okay?
Yes.
Awesome. Great, guys. Just another quick note that this recording will be available on our YouTube channel. So if you know anyone that would benefit from this and they missed this recording or the webinar tonight, it will be available for everyone. We'll be sharing it in all of our channels. And again, it will be on the YouTube channel. So really appreciate everyone coming out to pay attention to our cash flow statements webinar. Really thankful for you, Julia Glass, for doing this. I learned a lot, and I don't even have a farm. I was like taking notes, like this could be useful to me one day. So
yeah, well, they're fundamental for all businesses.
Right. And you broke it down really well. It does not seem easy, and you made it a little more simple. So really appreciate you doing that. Really, thank you so much for coming out.
You're welcome. Thank you.
Awesome. Thanks, everyone.
Bye, everybody.